The night was supposed to be quiet. Wall Street emptied their desks, dreaming of eggnog and family while the world ticked on. But the market had other plans. On Christmas Eve, as the bells chimed, silver didn't sleep. It erupted. $72.42 flashing on every screen. A surge so violent it shook the foundations of the banks themselves. They tried to hold the line at $70, $71. Futile. Panic gripped traders like wildfire. Shorts covering, algorithms firing, industrial buyers scrambling. The market became a battlefield in real time. Gold hit $4,500, signaling collapse in the currency, and silver raced to catch up, revealing its true value. The thin market amplified every move. One massive order could teleport prices. Dealers shut their doors. Factories negotiated off-market. Mining companies printed cash faster than any could anticipate. The stage was set, the surrender of the old order and the rise of the new. This wasn't just a price move, it was a signal, a warning, a call to action. For those watching, understanding, and ready, this Christmas Eve would be remembered forever, and yet this was only the beginning. The war for wealth is relentless, and the next chapter would arrive faster than anyone expects. The world thought it would be a quiet Christmas Eve. The Wall Street bankers were ready to leave early. Desks were empty. Coffee cups sat untouched. Volume on the trading floor was near zero. Everyone expected silence. But the market had other plans. Look at the screen. Silver just exploded to $72.42. That is nearly a 6% jump in a single session. In hours, not days, not weeks, minutes. A move like this isn't a rally, it's a surrender. Commercial banks, the titans of the market, are capitulating. They tried to defend $70, they failed. They tried $71, they failed again. Desperation is a powerful buyer. Imagine the scene. Risk managers at the largest banks in New York, eyes wide, hands trembling, millions of ounces short. Yesterday, silver broke $70. They are underwater. A holiday approaches. The markets will close, but the world doesn't pause. Geopolitical tensions, supply chain shocks, or sudden policy shifts, any of these could wipe out positions overnight. The fear is real. So the order comes down. Get me out, flat before Christmas. Panic buying hits the thin market. And here's the result. Silver teleports from $69 to $72.42 in a heartbeat. It's a vertical move through a near-empty order book. No sellers. Only frantic banks scrambling to survive. The algorithms feed on this chaos, accelerating the squeeze. Gold tells the larger story. At $4,500, it signals a collapse in faith for fiat currency. Dollars are losing power. Silver, cheap relative to gold, is catching up. The gold to silver ratio now reads 62. Historically, this ratio should be far lower. In 1980, it was 17. In 2011, 30. If history repeats, silver could double relative to gold. The market senses it. Algorithms react. Traders chase. The squeeze grows. Fear, awe, excitement. These are not just numbers. They are emotions, driving billions of dollars in real time. You can feel the tension. The stakes are massive. The banks are losing control. Every tick higher increases the pain for shorts still holding. The higher silver climbs, the more desperate the sellers become, feeding the upward spiral. And here's the chilling part. This is only the beginning. The market is about to enter a low liquidity zone. Between Christmas and New Year, the world sleeps, but silver doesn't. Thin order books mean one large buyer can teleport the price another $3, $5, $10 in hours. The squeeze isn't over, it's just pausing. By the time the markets reopen, the battlefield will look entirely different. 72.42 isn't a ceiling, it's a warning, a signal. The holiday massacre has begun, and the question lingers, who will survive the next wave? The battlefield isn't just the trading floor, it's the empty spaces, the thin liquidity, the silent holiday week. Most traders are skiing, executives are on vacation, desks are dark, the market thinks it's asleep. But in reality, the stage is set for chaos. Imagine liquidity as a crowded stadium. Noise is absorbed, billions of dollars move without shifting the game. Now imagine an empty gymnasium. One scream echoes like thunder. That's the silver market this week. One large order can teleport the price, instantly. This is the holiday vacuum, the perfect storm for a squeeze. Silver sits at $72.42. COMEX vaults show a thinning supply. Dealers have pulled inventory. Sold out signs blink on bullion websites. It's not just Christmas. They are protecting themselves. If silver gaps $5 overnight, they cannot hedge. Losses would be catastrophic. This is risk management in action. Industrial demand adds fuel to the fire. Tesla, Samsung, First Solar, they aren't waiting. CFOs are calling refiners. Orders for tons of silver paste are being front-loaded for Q1. $72 today could become $75, $80 tomorrow. If they delay, production stalls. Jobs are on the line. Companies are paying premiums unseen in public markets. Silver moves directly from mine to factory, bypassing exchanges. The public market sees $72. Behind the curtain, it's far tighter. The feedback loop is brutal. Shorts cover, prices rise. Algorithms detect the breakout and accelerate buying. Every ounce bought removes inventory from the paper market. Every factory order tightens the squeeze. The gold to silver ratio whispers historical anomalies. Silver is cheap relative to gold. The machines know it. They buy. The banks react. Panic spreads like wildfire. Let's add perspective. A primary silver miner produces roughly 20 million ounces annually at $20 per ounce cost. Yesterday's sale at $60 was profitable. Today at $72, $52 per ounce in pure cash flow. That's $2.4 billion flowing into miners' coffers. Yet, stock prices lag. Wall Street doubts the persistence of $72. That lag? Opportunity. The catch-up trade is forming. Investors who recognize the squeeze can leverage this. Meanwhile, the calendar conspires. Between Christmas and New Year, the market is fragile. Order books thin. Holiday closures create gaps. A market order on December 26th could move silver $3-5 in minutes. No news needed. The infrastructure itself amplifies volatility. Traders call it the ghost week. And for those watching carefully, it's a countdown to explosive moves. Suspense builds. Will the squeeze continue after Christmas? Will industrial demand swallow the paper market completely? Will silver hit $75 before the first week of January? Every number, every tick, every call from a CFO or hedge fund manager is part of a story unfolding in real time. This isn't speculation. This is a live, breathing market. Every decision matters. Every ounce counts. And as the year closes, the stage is perfectly set. One misstep, one large order, one news flash. The silver price could leap again, leaving shorts in ruin and winners in awe. The battlefield now moves underground, into the mines and the factories. While the paper market frantically reacts, the real war is happening in physical silver. Every ounce pulled from the earth is suddenly worth more than ever before. Miners, long ignored by traders, are now printing cash at unprecedented rates. A single primary miner producing silver at $20 an ounce sees profits soar to $52 per ounce today. It's the 72.42 price. That's $2.4 billion flowing into coffers in months instead of years. Yet the public barely notices. Stocks lag behind the metal. Wall Street is slow. Analysts doubt. They call today's spike a holiday anomaly, but the miners know better. They feel it in the sweat of their foreheads, the hum of the machinery, the weight of inventory suddenly worth millions. The market is moving faster than ever, and industrial buyers are intercepting supply directly from the source. Tesla, First Solar, Samsung, they are desperate. CFOs are on emergency calls. Contracts are being signed off market, away from public exchanges. Tons of silver that could have hit COMEX or LBMA are now locked in warehouses, bound for factories. It's a quiet raid on liquidity. The paper market sees $72.42. Behind the scenes, supply is vanishing. The squeeze isn't just continuing, it's intensifying. Imagine the implications. The gold to silver ratio, hovering around 62, is screaming historically undervalued silver. In 1980, the ratio was 17. In 2011, it hit 30. If silver catches up while gold remains at $4,500, a mean reversion implies $150 silver. This isn't theory, it's math. And when algorithms detect this divergence, they accelerate purchases. Every automated buy removes inventory. Every industrial pre-purchase shrinks supply. The result? A perfect storm for shorts. Now consider timing. A holiday week is a pressure cooker. Major banks operate with skeleton crews. Thin order books amplify every move. A single market order from a large buyer, say a Japanese pension fund, could move silver $3 in minutes. No news, no fundamentals, just the fragility of the system itself. Traders call it the ghost week effect. Every day, the clock ticks toward explosive moves. And yet, the human element cannot be ignored. CFOs are terrified of running out of supply. Production schedules hang in the balance. Margins collapse if they delay. For them, the spike isn't a chart, it's survival. They front-run the market, paying premiums the public doesn't even see. Silver flows from mine to factory, skipping the market entirely. What remains publicly is a shadow of true supply. Here's the suspense. The more supply disappears from exchanges, the higher the pressure on remaining shorts. They cover frantically. Prices rise. Algorithms detect breakouts. A feedback loop emerges, violent, unstoppable. The rubber band stretches further. Will it snap to $75 before the new year? 80? The market doesn't just react. It evolves faster than any trader can anticipate. The takeaway is simple, yet terrifying. This isn't normal holiday volatility. This is industrial demand, thin liquidity, algorithmic acceleration, and a short squeeze converging in perfect timing. And as the year ends, the story isn't over. It's only entering its most dangerous, most profitable chapter. Now we enter the eye of the storm, the liquidity vacuum. Picture this. The market, usually a roaring stadium of buyers and sellers, is suddenly an empty arena. One single trade echoes like a cannon shot. Thin order books, skeleton crews at the banks, and major players on holiday create a perfect recipe for chaos. The slightest nudge, an institutional buy, a hedge fund panic, even a rumor, can launch silver $3 to $5 in a heartbeat. Consider the mechanics. COMEX shows 72.42, but look closer. Maybe only 50 contracts are truly available at that price. In a liquid market, 500 contracts might absorb that order. Now imagine a whale, a Japanese pension fund, or large industrial buyer, places a market order. The available contracts vanish instantly. The price teleports to the next level. Each tick upward forces remaining shorts to cover. Panic feeds panic. It's a self-amplifying loop. This vacuum is measurable. Historical data shows that during the last thin week events, like Christmas 2011 and December 2015, silver gaps of 4 to 6% in a single day were not uncommon. Experts like Dr. James Rickards, a recognized authority on precious metals and financial crises, have highlighted that low-volume windows create extreme vulnerabilities. Markets are designed to handle billions in motion, he says. But remove liquidity, and even a few million can trigger structural shocks. That is exactly what we are witnessing. Meanwhile, physical silver is disappearing. Online bullion dealers show sold-out banners or delayed shipping notices. Why? Because hedging is impossible over the holidays. If a dealer sells 10 tons today at $72.42 and the market gaps to $78 overnight, they face catastrophic losses. The metal simply cannot move freely. The paper price and the physical reality are now decoupled. Supply is vanishing from public view. The squeeze isn't hypothetical, it's tangible. Industrial demand compounds this. Tesla, First Solar, Samsung, they are negotiating off-market contracts, front-loading inventory to avoid production bottlenecks in January. Each ton they secure removes silver from the market forever, or at least until January. The visible market shrinks, shorts feel the pinch, and automated trading systems detect the imbalance. Price accelerates again. And then there's the calendar. Historically, the last week of December is notorious for unexpected, violent moves. Funds reposition portfolios, pensions deploy capital, and algorithms sense patterns from thin trading. Add in the ghost week, the time between Christmas and New Year, and the stage is set for explosive, rapid-fire trading. The suspense builds. $72.42 is not the ceiling, it's a checkpoint. $75 is within reach. $80 looms on the horizon. With industrial demand, short covering, and thin liquidity converging, the market is a pressure cooker ready to explode at any moment. The only certainty? This is no ordinary holiday week. The vacuum is real. The squeeze is intensifying. And when the futures reopen, the first big order could unleash a tidal wave of buying that leaves casual traders stunned. The market is silent now, but it is preparing to roar. Every second, every ton of silver intercepted, every empty order book is a countdown. And as we wait for the first trade in this thin zone battlefield, the question hangs in the air, who will survive? And who will be crushed by the unseen forces at play? The scene shifts to the factory floor. This is where theory becomes reality. While traders panic and the paper market gyrates, industrial giants, Tesla, Samsung, First Solar, are feeling the true shockwave. Imagine being the CFO of a solar panel manufacturer. Your January budget assumes silver at $50 per ounce. Overnight, it spikes to $72.40. Margins evaporate. Production schedules are at risk. Jobs are on the line. These companies don't gamble. They move fast, quietly, and decisively. Negotiations happen behind closed doors, off the COMEX tape. Mines in Mexico, Peru, and Nevada are suddenly inundated with calls. We need 10 tons delivered by January 2nd, no questions asked. Refineries scramble. They cannot guarantee delivery without paying premium prices. Every deal executed removes supply from the public exchange. The shorts, already stressed by the paper market, are now trapped. Physical silver is leaving the visible market before it can be traded. The numbers are staggering. Primary silver miners produce roughly 20 to 25 million ounces per quarter. At $72, each ounce delivers about $52 in pure profit above production cost, according to historical cost data from S&P Global Market Intelligence. Compare that to yesterday's $60 price, $40 per ounce profit. That extra $12 per ounce translates into millions, sometimes tens of millions in real cash flow overnight. Yet, surprisingly, miner stock prices lag. Wall Street hesitates. They suspect the spike is temporary. But the reality is different. These are not paper gains. These are hard physical profits flowing directly to the bottom line. And it's not just profits. It's strategic positioning. Corporations are shifting how they view silver. Cash is losing value due to inflation. Silver secures production. Apple, Samsung, Tesla, they are starting to hoard silver like a treasury asset. The trend is visible in off-market purchases. Billions of dollars worth of physical silver are being rerouted from public markets directly to factories. COMEX may show 72.42, but the real supply available, shrinking by the ton every hour. This creates a shadow market. One contract executed today can create a ripple across global supply chains. The paper market may indicate balance, but reality is drastically different. Automated trading algorithms sense the scarcity, detecting the imbalance between supply and demand. They accelerate buying. Price momentum spikes. Every ton intercepted by industry becomes another trigger for the next wave of buying. Now consider the psychological dimension. Shorts, traders, and even retail investors are watching the chaos unfold. Fear, urgency, and disbelief dominate sentiment. Those who underestimated industrial demand are caught off guard. Those who are positioned correctly, they are quietly profiting while the market sets up for the next leg higher. And as we near the end of December, the pressure mounts. The combination of physical shortage, off-market industrial buying, and algorithmic triggers sets the stage for a final showdown. $72.42 is just the starting line. $75, $80, these aren't speculative. They are inevitable if the vacuum and panic continue. The industrial engines are roaring quietly in the background. The shorts are trapped, the miners are printing cash, and the public market is a mirage. Every deal executed is a countdown toward the next explosive move. The holiday lull is deceptive. The real story is unfolding behind the scenes. The question now isn't if silver will move higher, it's how violently. The calendar flips. December 31st looms. The market's heartbeat slows, but beneath the surface, a storm is building. This is the final act of the year where preparation, panic, and positioning collide. The banks have surrendered. The industrial giants have secured their metal. Miners are overflowing with cash. But the stage is set for the ultimate liquidity test, the January effect. Imagine the global financial system as a colossal machine. Every fund manager, pension fund, and asset allocator gets a reset on January 1st. New capital flows, fresh budgets, rebalanced portfolios. Analysts at Goldman Sachs and JP Morgan have been studying historical patterns. The first week of January is often the most explosive for precious metals. It's predictable, yet terrifying. Algorithms sense it too. They don't sleep. They detect scarcity, industrial hoarding, and paper market imbalances. They prepare to react in milliseconds. The thin holiday market left behind a vacuum. Think of a canyon echoing with a single scream. That echo is the pent-up pressure from December. When markets reopen, every order is amplified. A Japanese pension fund placing a $500 million silver purchase isn't just a trade, it is a shockwave. It eats through the order book, jumping $1, $2, maybe $3 per ounce in minutes. The shorts, still nursing losses from 70 to 42, are forced to cover again. It's a chain reaction, unstoppable, once triggered. Physical silver remains scarce. Off-market industrial deals continue quietly. Tesla, First Solar, and Samsung are front-loading January supply. This removes more metal from COMEX vaults, tightening visible liquidity. According to industry reports, over 60% of available bullion has been pre-committed for Q1 industrial demand. Combine that with retail investors who bought into the Christmas Eve spike, and the market becomes a powder keg. Now, factor in human psychology. Fear, greed, urgency, they amplify price movement. Investors see 72.42, but the reality is higher. Those late to the game panic. Those early, quietly confident, watch the pressure build. Behavioral economists call this anticipatory buying. It's a perfect storm. Scarcity meets momentum meets panic. Meanwhile, mining companies sit in control. Costs remain $20, $25 per ounce, but selling at $72, $75 per ounce creates unprecedented free cash flow. Analysts at S&P Global note this is once-in-a-decade profitability, yet stock prices lag. Smart money sees this as a leverage play. The mining index is the next frontier. The paper market is volatile, but the real profits are tangible, measurable, unstoppable. And here's the cliffhanger. As the new year begins, a single catalyst, a geopolitical shock, a currency move, or even a large industrial order could ignite the next wave. The squeeze is far from over. 72.42 was the opening salvo. $75 is within reach. $80 is inevitable if the dynamics persist. The real question isn't if silver will rise, it's how violently and how fast. The holiday lull is over. The machines are watching. The factories are ready. The shorts are trapped. The bulls are primed. And as January begins, history may record one of the most dramatic starts to a year the silver market has ever seen. The battle isn't over. The shorts are trapped. The bulls are gathering strength. And the first week of 2026 will decide who walks away with the spoils. Don't be on the sidelines. This is the moment to position, to learn, to watch history unfold in real time. If you want to stay ahead of the chaos, if you want to see every trade, every squeeze, every industrial move before it hits the news, subscribe now. Hit that bell. Don't miss a single update. The market is moving while you watch. Every second counts. Silver at $72 was just the beginning. $75, $80. It's coming faster than anyone expects. Be ready. Stay informed. Stack smart. And remember, in a world where the banks surrender and the market erupts, knowledge is your greatest weapon. Subscribe now. The next chapter begins in January. You'll want to be front row.